Hello, everyone. Welcome back to Navellier Market Buzz, episode 20. I'm Crystal Navellier, and I'm joined again this week with my father, Louis Navellier. And of course, we have our special guest, Jason Bodner, who's the co-founder of Map Signals. Jason, it's great to have you again.
Thanks for having me. Glad to be here.
So it's earning announcement season, which, Dad, I know is more exciting than the football playoffs. Let's first talk about what you guys think about Bank of America.
Well, their revenue is supposed to be up 14.3%. That's the analyst estimates. Earnings is supposed to be up 119.5%. But despite that spectacular sales and revenue, their guidance is going to be very critical because, consumer default rates are at the highest levels since 2010. Banks often have these loan loss reserves. So if they can provide upbeat guidance, the stock should do very well.
Yeah, so we at Map Signals, a lot like Louis, your stock grader, we assign a ranking, so we go by the Map score. Our sweet spot is typically 70 to 85. This is just outside. It's got a 69 overall score with a strong 73.5 technical score. Where it's getting penalized for us is fundamentals, and that's with negative 1 year sales growth. The 1 year sales and 3 year sales growth looks positive, along with 3 year earnings growth. They do make a nice profit margin, but they are heavily levered. I guess on the good side, 1 year sales and earnings estimates are positive. So overall, I like this company except for the heavy debt to leverage ratio.
Now, what do you guys think about BlackRock?
Of course, they're taking over the world, as you might know. Larry Fink's their chairman. Their revenue is forecasted to go up 21.6%. Their earnings are forecast to go up 17.3. So anytime the earnings aren't growing as fast as revenue, the margins are under compression. They're going to have to give good guidance. Now, they're entering the private credit business a little late. This is a $2 trillion a year industry. And private credit is out there promising up to 11% yields through various brokerage firms out there. And I think they better be careful because last I looked, the leveraged loan market, which is behind private credit, had a 7.2% default rate. So, this is like Bank of America. They're going to have to provide good upbeat guidance.
Adding on to that, our MAP score is 62.1. And this has a really decent fundamental score. I think it's being punished technically. It's been, trading range bound slightly down. I think it's down 5.4% in the last month, and it's down 4% on the year. Single digit sales and earnings growth for 1 and 3 years. That's sort of mediocre. It could be better. I'm kind of very choosy. I look for double digit sales and earnings growth. Does make a very nice profit margin of 29%. And they have, almost $3.8 billion of free cash flow, less their capital expenditures. Like Louis said, positive sales and earnings estimates for next year. But another place that it gets penalized is when you take their cash, less their debt, it's negative. So it is a levered company, but after all, it is BlackRock. So fundamentally, it's pretty healthy. Technically, it's a little depressed. So like Louis said, if they come out and they guide higher, I would expect this stock to zoom.
Along the similar lines, what do you guys think about JP Morgan?
JP Morgan is the biggest, most dominant bank in America. It's led by Jamie Dimon, who's a very good CEO. And their revenue is supposed to be up 7.8%. Their earnings is supposed to be up 32.7. Those are analyst estimates. I expect they'll be pretty upbeat. Now, sometimes after they announce, Jamie throws cold water with his commentary expectations. So I think Jamie's commentary is going to be actually more important than the actual results. A lot of people want Jamie Dimon to be the next Treasury Secretary. And that might still happen one day, but his comments are going to be very, very crucial.
I think it's worth noting that JP Morgan is America's bank. organizing the very first bailout of the US government was James Pierpont Morgan. So there's a very hand-in-hand relationship forever. Our MAP score is 63.8. It's strong technically. It's mediocre, middle of the road fundamental. Again, we're really choosy. I mean, this company has great sales and earnings growth on 1 and 3 years. It's very profitable, 21% profit margin. But they do have a debt to equity ratio over 200%. So they're heavily levered. So in a vacuum, that could penalize them. But again, when you're America's bank and you're sort of hand in hand with everything with great leadership, like Louis said, if they post good guidance, have a strong beat and raise, I would expect good things for JP Morgan in terms of its share price and the sector in general, because it's a sector leader.
So now, do you think that Citibank is going to have similar earnings?
No. Their revenues are supposed to be up 11.9%. Their earnings are supposed to be up 47.3%. That's slightly better. But Citibank has a higher consumer default ratio. They give out credit cards to department stores and other vendors, like when you fly on an airline, everybody's trying to get you to buy their credit card. And so they don't quite have the credit quality that JP Morgan Chase has. So again, they're going to have to provide good guidance because the consumer loan defaults are the highest since 2010. They're going to have to address that and also their third-party credit card business. But the near term, their earnings and sales are supposed to be better than JP Morgan, but it's a riskier stock.
I'm sort of seeing a mirror here. Citigroup has a MAP score of 70.7, which is sort of right inside that green range, but it's got a really inflated technical score. So it's been bought up significantly. I think it's up, it's up almost 4 and change % year to date. Fundamentally is where it gets sort of penalized in the MAP scoring system. It's got really great 1-year sales growth, 55%, but 1-year earnings growth is down 42%. And we use FactSet statistics for this. 3-year sales growth and earnings growth are positive, but it's got a kind of a low profit margin, 6%, when you compare that to JP Morgan and Bank of America, what we were talking about before. They have larger profit margins. And Citigroup, when you take their cash flow less capital expenditures, it's negative $4 billion. So it's a heavily levered firm, 289% debt to equity ratio. So really, like Louis said, if you get any of those defaults higher than expected, it could really send the stock reeling because they're sort of cutting it so close to the bone. But again, if they come in, they guide higher and they exceed those sales and earnings estimates for next year, we could see good things from it. But, from a fundamental standpoint, I personally think there are better fish in the sea.
And just so everybody understands, the credit problem in America are largely for the people 30 and under. The boomers, the people that own homes and have money in the stock market, their credit's great. So this is why we have an issue in America. The kids are trying to figure out how they can live as well as their parents. And so everybody under 30 is still struggling.
Now, I'd love to talk about what you guys think about Kinder Morgan as well.
Well, this is a midstream company, and the more that goes through the pipelines and the midstream terminals, the more money they make. Nice dividend yield on this stock. Their revenues are only supposed to be up 2.3 according to the analyst community. Their earnings are supposed to be up 16.8. This is one that should benefit immensely under Trump because this is what he's going to do. He's going to do drill, baby, drill, and they're going to profit from all the flows of natural gas and crude oil through their pipelines.
Yeah, so KMI, Kinder Morgan, gets a MAP score of 72.4. It's in that sweet spot. Again, technically inflated 79.4%. And I think it's important to just mention that it's not like a school grade where you get 100 and that's perfect. If you get a technical score of 100, it's very extended and possibly parabolic, and you would think it might even fall back. So I do like where it is technically, Fundamentally, it's a little bit better than middle of the road with 62.5. And really what's pulling that down is negative 1-year sales and earnings growth. 3-year trend is a different story. So 3-year sales growth is up 14% and 3-year earnings growth is up a whopping 536%. They have a great profit margin of 16% and plenty of free cash flow minus their capital expenditures of over $4 billion. Their debt to equity is right around 100%. So these higher debt to equity ratios are more desirable in a falling rate environment, which is what we're in now. And like Louis said, they have positive 1-year sales and earnings expectations. So with Trump coming in, like he said, drill, baby, drill, this could be a very good tailwind for a stock that's already had a strong 3-year run. So I'm liking Kinder Morgan.
Now, what are your expectations for Schlumberger?
Well, this is an oil service company, huge, big international company. Revenues are supposed to be up 2.2%. Earnings supposed to be at 4.9, but again, under drill baby drill, they should do better. This is a big international company. You know, the new British Prime Minister did basically stop the expansion of drilling in the North Sea. Biden just passed an executive order trying to protect a lot of coastal water in America. It kind of ticked Trump off. He's going to try to reverse that. But they are a huge oil service company, so they should benefit under Trump, but they have a couple near-term hurdles thanks to the British Prime Minister and Biden.
Yeah, Schlumberger, major oil company like Louis just mentioned. So, you know, from a pure score perspective, this thing gets a below middle of the road map score of 44.8. We're talking a technical score of 26.5. That's pretty bottom of the barrel, and that's because it's been in a 1-year downtrend and stocks are near lows. Fundamentally, though, it looks pretty good, 70.8, and we're talking about double-digit percent 1-year sales and earnings growth, and the same goes for 1- and 3-year earnings growth. 3-year earnings growth of 51%. That's great. Does have a profit margin of 13%. And it's got free cash flow minus CapEx of $4.5 billion. It does carry some debt, 63%, but significantly less than Kinder Morgan and some of those banking companies. But really what's hurting it right now is this stock is in a deep downtrend. It does have negative cash when you take away its debt, and it's natural for these oil companies to have tons of debt to fund, you know, rigs, drilling operations, things like that. So from my perspective, to really get this stock moving, you would have to see a monster beat and a monster raise where it catches everybody off guard. Because if that does happen and a stock's trading near its 52-week lows, a lot of the shorts are going to have to cover, people are going to pile in to buy, and it could reverse the direction of the stock. So it'll be really interesting to see what happens with Schlumberger.
Great. And finally, I'd love to ask what your expectations are for Fastenal.
Revenue is supposed to be up 4.2, according to analyst community. Earnings is supposed to be up 4.8, but as the manufacturing sector improves, hopefully it will improve. Stock has a decent earnings surprise history. But again, it's going to be tied to the manufacturing sector of our economy. We had a very good ISM manufacturing report. New orders were up. So there's some green shoots, even though technically manufacturing in America has contracted 25 of the last 26 months. But when we do recover, and this is what Trump wants to do, get our manufacturing sector going, Fastenal should be a winner.
Yeah, it's sort of a pole position company in the, you know, tools and hardware store land. This thing gets a map score of 56.9. Technically, it's really middle of the road, right around 53, and the fundamental score is 62.5. Now, where it has sort of green across the board in terms of fundamentals, but they're not as strong as I would like to see them. 1-year sales and earnings growth, 5% and 7% respectively. 3-year sales growth of 9% and 3-year earnings growth of 11%. Those are all good. But generally I like to see double digit. They do make a profit margin of 16%, and they have plenty of free cash flow, less capital expenditures, $1.2 billion. Now, the stock is down 10% in a month. So, there's a lot of potential bottled up energy if they come and they beat and they raise earnings, and they, as Louis mentioned, are expected to have 1 year sales and earnings estimates positive. I'd like to see that double digits, but we'll see. I think one area where it is getting punished is their cash per share is negative. So a lot of these leverage companies, like I said, it's not a trait that I'm looking for in a stock. I like lower debt to equity ratios and lower and higher cash per share. But in a falling interest rate environment where the cost of their financing looks to be going down on the horizon, this is good news for heavier levered companies.
Yeah, and I should add for disclosure, my firm does own Kinder Morgan, some dividend accounts. It's not in the growth accounts. So the stocks we just talked about are all the ones they're announcing next week. And we'll keep doing this every week as earnings season progresses. So we are talking about stocks that we don't always own.
Now let's switch over to stocks in the news. Perimeter Solutions was popping up. What are your guys' thoughts about them?
Well, I own this stock. They make the fire retardant that you spray around homes. And, I'm filming right now in Reno. And obviously, they use fire retardant around here when we have our fires. But obviously, when the fire hydrants stop working, the fire retardant's a bigger deal. And this is what the planes are dropping on the fires. So this stock has popped this week just because of the horrible tragedy in Los Angeles. This is going to rival Hurricane Katrina for losses. And it's very, very tragic. And I've already talked to clients that have lost homes. It's just horrific. It looks like it's going to be much worse than the Maui fire, but it was similar. Very odd winds pouring out to the sea. Anyway, we own it. It's benefiting from the tragedy we've had this week.
Stock, my analytics doesn't really love. It gets a map score of 46.6, technical score right in the middle. It was depressed. It has popped since the fire. Fundamental score of 41.1. And, I'm just seeing negative sales and earnings growth on a 1 and 3 year basis. Now, that obviously can all change if they have a huge pop from this unfortunate disaster. They do make a profit margin of 21%. That's great. Their debt to equity ratio is elevated at 69%, and they have negative free cash flow, less capital expenditures. The other thing that's showing up in my data, 1 year estimated earnings growth and estimated sales growth is negative, but that obviously is not taking into account what's going on in the past couple of days. Lastly, it has negative cash per share. So it'll be really interesting to see the guidance because, last quarter's numbers are already in. That's what they're going to report. When they report, which is March 20th, we're going to really get to see what kind of boost this comes in as. So it'll be very interesting to see.
I should add that for this current quarter, their revenues are forecast to be up 20.2%. Earnings is supposed to be at 24.1. And this company's a little like an agriculture company. The ag stocks have 2 strong quarters a year and then 2 weak quarters. Energy is also similar to that, especially crude oil, because demand goes up in the spring, goes down in the fall. But this particular company does sell a lot more of its fire retardant products just before fire season. So I think what's happening is their sales got off to an early start.
Along the same lines, Arch Capital Group was also popping up.
Well, it's popping up, but it's fighting 2 problems. I own the stock. It's a reinsurance company, and it has 2 problems. One is rising bond yields. Our treasury yields are at the highest level since 2007, and there's headed higher after the very strong payroll report. The 30-year treasuries up over 5%, and the 10-year Treasury was 4.79 the last I looked. And that's a lot of people don't think the Fed will be cutting rates. So this stock will do better when rates go down because reinsurance companies have huge bond portfolios that appreciate when rates go down. But in the interim, what's weighing on this company is its liability from the fire. So all these insurance companies, and obviously there's an insurance problem in California. Some people are insured, some are not. But the people that are insured, their insurance company, whether it's State Farm or Progressive or whoever, will often rely on the reinsurance companies to help pay. And so Arch Capital is going to be sitting there waiting to see how much their liability is. But this is a horrific tragedy. Crystal, where you went to high school, you had friends in the reinsurance business. Remember, they were always going to Bermuda. And the issue with reinsurance is uh, they really are hurt by natural disasters. So the floods in Houston, when the hurricane stalled over Houston, were devastating to reinsurance. I'm sure these fires in LA are going to be horrific too. So we'll just have to see what the liability is, and we just don't know right now. And we do have this under management. It's in dividend portfolios as well as some growth portfolios.
At Map Signals, we have this stock in several accounts, some managed, some publishing as well. I personally love this stock. Right now, it's getting a MAP score of 53.4. So a lot of MAP scores, we're looking backwards. So obviously, we're talking about, current events and how their potential exposure is in this fire. But a technical score, it's 41.2. So because it's sold off from highs about a few months ago. On a fundamental score, we got 70.8. And that's because historically, we're looking at 1 year sales growth of 41%, 1 year earnings growth at 207%, 3 year sales growth 18%, 3 year earnings growth is 79%. These are awesome metrics. A profit margin of 33%. Free cash flow, less CapEx of $5.7 billion. And that's because insurance companies, they have to carry cash in the form of float to pay for claims. But the scope of the disaster, that's going to be a drop in the bucket. So like Louis said, it'll be really interesting to see what their exposure is. And a lot of that hinges on, there's a story floating around that California, the state of California, was negotiating with insurance companies such as State Farm and local carriers on not raising their rates. And insurance companies were like, well, we see increased liability to fire because of the underbrush management problem or whatever they were citing. So a lot of insurance companies attempted to cancel insurance on a lot of homeowners who are now just getting faced with total devastation. So it'll be really interesting to see what the level of exposure is because there's potential legal battle with this one. So it is a newsworthy stock, but typically with reinsurance companies like these, you're looking at longer time horizons because they make their money over years and years and years of no disaster. And then a disaster comes along, you have a setback, and then they move forward. So it'll be interesting to see.
Switching over to subscriber questions, could you comment on United Airline versus American Airlines?
Well, sure. In our portfolios and our newsletters, we recommend United Airlines. We don't recommend American. As someone that flies a lot, I would add that I think United is better run than American. I think its hub and spoke system's a little bit better. And unfortunately, American had to cancel a lot of flights, including me this week, because of the ice storm in Dallas. But Delta did beat. They announced and they were rewarded. The stock kept up. So the airlines are hot. And in addition to recommending United, we also recommend Alaska Air, which is ALK. And we have those in portfolios.
From an airlines perspective, I can't say that I've ever been a huge fan of airlines. In the past, the airlines that I've liked were Alaska Airlines as well, Spirit Airlines. What I'm seeing, real quick from a perspective of UAL, United Airlines, we have a MAP score of 75.9, really strong technicals. decent fundamentals for an airline, very strong sales and earnings growth in 1 and 3 years, and a 5% profit margin. Now, expectedly, it's a heavily levered company, a lot of debt to pay for equipment and fuel, et cetera. But they're forecasted to grow sales and earnings. And obviously, ever since COVID, there's been a boom of traveling that sort of sees no end in sight. So I am liking United Airlines. I also like American. It's got a 69 map score with a 80 technical and a 54 fundamental. Again, really strong sales and earnings growth, a lower profit margin, a 2% gross profit margin, but they do have plenty of free cash flow. Again, a levered company, but they have very strong sales and earnings estimates for next year. So as far as airlines go, I typically don't love them given the debt to equity ratio, but these two are hitting all the marks.
Jason, how does SkyWest look? That's SKYW. SkyWest. They're
SKYW is,
feeder for Alaska and United. And that's the first airline that showed up in our system, and we own it.
so that one's got a map score of 65.5, technical score is 73.5, which is nice and strong. Fundamental around 54.2. But again, airlines get punished with debt because I don't factor in debt for this industry versus tech, say. It has negative sales and earnings growth last year, negative 2% sales growth, negative 46% earnings growth. 3-year sales growth of 12%, but 3-year earnings growth of negative 40%. They just eke out a profit margin of 1%. They have plenty of free cash flow. They're levered about 150%. But they do have estimated sales and earnings growth next year. So it's kind of a middle of the road fundamental stock for me with some technical strength right now, in the absence of anything else.
I can confirm SkyWest will have blowout earnings since the current quarter is looking awfully good.
That's great. It's one to keep on the radar. No pun intended.
Another one of our subscribers wanted to know what your thoughts were on USAP.
Yeah, that's Universal Alloy and Stainless Steel. Metal fabricator. Sales are only supposed to be about 4%, but earnings are supposed to be up over 240. We have a lot of companies that supply aviation. And then, of course, automotive is getting increasingly sophisticated. It was interesting. We bought that Escalade crystal, and I thought it was all steel, but the doors are aluminum, the hood's aluminum, and I found that to be interesting. That's a big vehicle. I guess they're trying to keep the weight down. And then, of course, we have the Cybertruck nowadays, which is an example of really high-end stainless steel being put in some vehicles. So Universal Alloy and Stainless Steel products are benefiting from both the automotive industries, increasing demand, but especially aviation.
Like you said, alloys, nickel alloys, tool steel, all that stuff. This is a middle of the road stock for me. Map score of 55.2, technical 53, fundamental 58. So stronger fundamental than technical. I generally like that. Represents potential value. Strong 1-year sales growth, but negative 3-year earnings growth, which indicates it's probably a bit of a newcomer. Although this company's been around, it's been founded in 1994. Does make a 2% profit margin. I'd like to see more. It has a little bit of free cash flow, but a 38% debt to equity ratio. So generally, I like to see all greens. Like if we're looking at 6,000 stocks, like we're just talking about stocks in the news and what people want to know about. I think, Louis, you have the same general feeling. You're looking for the creme de la creme, the best of the best.
Yeah, it's still not a sector market. It's still a stock picking market. So, it's just like Nvidia scores high in our system, but Advanced Micro Devices, AMD, and Intel, INTC score very poorly. So, and it's funny, we do sector management on ETFs, and that's our slowest portfolio last year. We were recommending financials but that actually got sold in the sector of management.
Mm.
So, so that's why this earnings season is going to be interesting next week because this is when the financials report. But yeah, it's still stock picking, and even as we record this, it's a sloppy day, and we got a lot of strength on the surface, so I'm pretty happy.
Now, switching over to global economic news, I was quite surprised to see that the Chinese bond yield dropped below Japan's. Can you explain why?
Yeah, China's in a lot of trouble. In fact, they are probably the next Japan. We expect their rates to be low and possibly negative for up the next 2 decades. And the reason's simple, they're just losing people. I don't have the number what they lost last year, but I'm sure it's at least 2 million. The year before was 2.08 million. This is what happens when demographics hurt your country. And this is a worldwide phenomena. It's really hurting Europe. It's hurting much of Asia. And China also, like Japan, has a lot of bad bank loans. And the banking crisis in Japan was triggered by this well over 30 years ago. But what happened in China is people were buying real estate for speculation and never moved in the homes. And so there's all these houses and high-rise condos that are empty. And it's a real problem. And they're masking their loan problems. And then also President Xi, the president for life in China, has terminated a lot of the reformers. So the world doesn't have confidence that China is being managed fiscally um, um, well. And the other comment, they have rampant deflation. So we hope that deflation spreads to America, and we'll find out soon.
Yeah, it's interesting. I mean, they had population limitation going back to Chairman Mao, right? It's pretty ingrained in the culture. And then speaking to your comments about real estate, I mean, starting in 2020, they had a major real estate crisis with a lot of leveraged debt, unoccupied real estate, overdevelopment. So that's still working its way through the system. Um, so yeah, it's really interesting because that works its way into all Chinese stocks. And you're talking about a large, contingent of tech leadership in China, et cetera, that gets under pressure with the whole region. So um, it really is a bit of a mess right now over there.
Now, can you explain to me why currencies around the world are so weak? Can you start with Vietnam?
Yeah, that's a bit of a surprise. Vietnam has record exports to America. I think it was over 110 billion last year, but their currency is very weak, so they're more competitive. And the weaker your currency, the more the U.S. is going to buy. So it's up to Vietnam to convince the world that they're well managed. They've obviously had an incredible success story, but yeah, they just I was shocked how weak their currency was versus the U.S. dollar.
Now, you already mentioned about China, but can you expand a little bit more about them?
Sure. China is part of the BRICS nations. That's Brazil, China, India, Russia. I think South Africa considers itself a BRICS nation. And they were trying to trade more direct with each other and not use US dollars. And the Brazilian president, he went all the way to Shanghai and announced that to everybody in the world that was at this conference that you must trade in Chinese yuan versus US dollars. Well, incoming President-elect Trump said if you promote that kind of trade policy, we're going to have a 100% tariff on you.
Hmm.
So that's one of the reasons he wants to put a tariff on China, but he will also do it to Brazil, India, South Africa, and of course, Russia. We always got so many sanctions, it's another matter. But ever since he said that, Brazil's been quiet. So, it's uh, so this policy is not being rewarded, and most of the BRICS countries have very weak currencies, I would say, with the exception of India.
Mm.
And finally, what about Mexico?
shocking. The peso fell 19% against the US dollar last year. A lot of that was in the summer months after the election. I guess there was some concern of the new legislatures messing with the judicial branch. But no, Mexico should have a strong currency because they're a huge exporter to America, and we're growing. Last I looked, we're still growing over 3%. So I was shocked by that, but it'll be up to the new Mexican president to install confidence. And of course, right now she's a very colorful politician. I guess that's the best way to describe her.
They're feuding about the Gulf of America, right? And getting into a spat there.
Yes, and Trump wants to rename the Gulf of Mexico to the Gulf of America. And then she countered that she would like us to be renamed the Mexican America. So it's her and Trump are having fun with each other. And so that's going to be one of the more interesting meetings. And the truth is, we do a lot of trade with each other. We need each other. So I'm sure it'll all end fine. But in the meantime, they're having fun insulting each other.
It would be great if they could resolve it on Cinco de Mayo and give everybody a real reason to celebrate there.
Yeah, yeah. But NAFTA allowed Mexico to boom. And
Mm.
that whole Monterrey, Mexico area is a huge manufacturing hub. And interestingly, Mexico needs natural gas from the U.S. to keep their electric costs down. And we do export a lot of refined product to them because PEMCO, their oil company, that doesn't have the output it once did.
The producer price index is going to be announced on Tuesday. What do you expect from that?
That's more of a wild card, but I'm expecting goods prices to fall due to the strong dollar. We want to see where wholesale service costs are, but the dollar is so strong, we should get wholesale good prices falling, and also commodities are priced in dollars. So that will be the big thing in the PPI.
And of course, the CPI will be announced on Wednesday.
That's all owner's equivalent rent, shelter costs. 90% of our inflation is that. I should mention that there has been some food inflation, both the PPI and the CPI, due to the bird flu out west. But as you know, that's okay because we own those egg stocks. Cal-Maine already announced and beat, acted well, and then of course Vital Farms will be announcing in the upcoming weeks.
Yeah, I think from the CPI perspective, you know, we've just been in a slow descent. And obviously, every time there's a report, the market gets jitters over 0.1% here or there. But, this time last year, CPI was 3.1, and a year prior to that, it was 6.3. And, we had an inflation all-time high during COVID of 9.2%. So steadily falling. And like Louis said, there's such sensitivity to owner's equivalent rent, but everywhere else, prices are either stabilizing or continuing to fall. So
Yeah,
I would expect the same.
The reason there's no housing inflation in like Europe is they're not creating households. They're getting old and they're dying. And so they don't have household formation and like we do. So the other thing is, of course, in America, we assimilate immigrants better than these other countries do. Britain obviously has 84 Sharia courts now. France isn't assimilating. Germany used to assimilate Turks and Syrians pretty well, but the last wave they got isn't working out that well for them. And when you have these countries where people are fleeing, the richest, the most educated people flee first. And then, but when you get to the fourth or fifth year of the flight, it's the people might not be as educated or as productive. And so in America, we're just very unique. Obviously, Trump's going to proceed to deport the criminals and gang members, and he might deport several 100,000 people. But I cannot imagine he'll deport people with jobs. even if they got here illegally. So this is going to be very interesting. If he does, it's going to make food prices go up. So, because the Tyson Foods, the Hormels, they will hire these immigrants, and then they will process their paperwork with the immigration agencies.
Yeah, it's a good point. A lot of those illegal immigrants who have legitimate, work ethics and things like that will do a lot of the jobs that people don't want to do. So if we export all those people, the cost to fund that labor will significantly increase. And that's been a big topic at
It,
this.
it, it will not be possible to rebuild Los Angeles without that labor. So,
Right. Right.
And finally, what are your expectations of the retail sales that will be announced on Thursday?
should be pretty good. Based on what we're seeing with consumers, we should be growing close to 3%. 70% of our economic growth is tied to consumer spending. The holiday shopping season looked pretty good. But again, we have two tiers of consumers. People above 30 are doing better than the people below 30. But the boomers have all the money, so they're spending, so it should turn out great.
Perfect. Well, thank you to you both for answering all my questions, and thank you to you all for liking and subscribing. Once again, if you have any questions, please leave them in the comments below. But until then, we'll see you all next week as we will go through a new round of stocks for their earning announcement season. Thank you so much.
Thank you.